So welcome to class 2. In this lesson, we're going to learn about market cycles and defining your trading style. So let's get started. So when we talk about market cycles, stocks are either in a period of consolidation or a trending period. A stock is either trending up, trending down, or going sideways, or what we call stuck in a range. We are momentum trend traders. We want to focus on periods where the stock is moving in a recognizable way. It doesn't matter if the stock is moving up or down. We can make money trading both ways of the market. So when we talk about the four phases of the market cycle, we got the first one, which is the accumulation phase. Second, we have the run-up phase. Third, we have the distribution phase. And fourth, we have the rundown phase. In the accumulation phase, it's a trendless period in which traders and institutions are buying shares, right? Let's say that you have a stock that you think is undervalued and can go up in value, and you want to take a rather large position. However, you can't just go buy your entire desired quantity. So let's say that you want to buy 200,000 shares of something. If you went and bought 200,000 shares, maybe the stock's not doing much volume as the weeks leading up to it. So what you're doing is you're actually buying everybody's shares, right? So if the stock's only doing 250,000 shares in volume a day, and you want to buy 200,000 shares, you're going to drive that price up. And other traders are going to jump in there and they're going to start buying as well. And you're not going to be able to maximize your profit target. So what companies do, right, big investors, institutions, hedge funds, is they'll start buying little by little here and there, right? Nothing to tip off anybody else because, again, they have a desired amount of shares that they want to purchase, but they don't want to purchase it and continue purchasing it at a higher cost because it would increase their average cost basis, right? So what happens, it usually comes after a big tank of the stock or the market overall is kind of down. So it's done going down, but it's not ready to go back up. So what these big companies do, or these big hedge funds do, is they come in and they start buying a little bit, right? These are the big fish. These are the market movers. These are the people that can make a stock go up or go down because they have a lot of quantity, right? They have a large number of shares in their position, so they can actually make the market. It's easily identified because the stock price and the moving averages, they're generally moving sideways. So if we take a look at this example, I don't have the moving averages on here, but you can see the stock takes a big dump down here, and then it just kind of gets stuck in this range. It goes up, right, has this resistance level, and it comes down, and it's got the support, and it's just traveling in this range. There's no real edge to a trade. So to get in this trade, you would be holding dead money because the stock's not really going anywhere. Remember, like I said, we are trend traders, right? We want momentum. Sideways is dead. It's not going anywhere, right? But here, not a good trade, even though it's easily identifiable and for the most part, it's consistent. Again, there's no edge. We have no guarantee that this is going to continue like this. But again, so what we do is we start watching it, right? We start watching the volume. The volume starts ticking up. So this is what tells us, right? We start seeing a little bit bigger green candles, or we see multiple green candles in a row. That's telling us that other people are seeing the value in this stock. So again, we may not want to buy, or we may not want to take a large position. We might want to nibble, right? So think of yourself as the little fish, right? And think of these hedge funds as sharks, right? So you've seen on oceanography documentaries how the little fish swim alongside the shark, because the little fish knows that it cannot hunt and kill the same types of prey that the shark has. So what happens when the shark eats his prey? He tears it apart, and the little pieces kind of go off to the side, and who eats them? The little fish. That's you and me, right? I'm okay with swimming beside a shark and letting the shark do all the heavy lifting and all the killing, and I'd have no problem picking up all the extra crumbs. Because why? I didn't have to do any work for it. If you're smart enough and you can see when companies are accumulating stocks, then you can hop on and ride it. So that's what happens, is right now it's just stuck in the accumulation phase. So when we talk about the run-up phase, right, the run-up phase is when demand has exceeded supply and the buyers are chasing a limited number of shares, which drives the price in an upward trend. The stock prices, they make higher highs and they make higher lows. This is where you get your moving averages. They start moving up. Traders want to buy shares. We call this being bullish. And this is where stocks can go absolutely parabolic at this stage. So again, if we look right here, the stock comes down, it flushes, and it gets stuck in this accumulation. Companies, they start picking up shares, investors start picking up shares, retail traders, they start seeing it. And once it starts moving up here, and then look what happens. Then you get the big run up. Boom, up here, all the way up here. I mean, look where you're at, from down here all the way up here. That's the run up phase, right? That's the run up phase. And here, I'll show you a perfect example. This is a stock, this is a long time ago. This iBio, right? This is all accumulation phase. And you can see, like, you've got some green candles, but there's nothing really big. There's no big red candles, which would signal a sell-off. And there's no big green candles, which would denote a whole bunch of people buying stuff. But you can see it. The bigger the green candles, now you're starting to get some movement here. So this is where people have been watching this. They think this iBio, it's gonna run. And they start picking up and they start accumulating their shares in anticipation of the run. So you get a little bit of a run right here, which is nice, but then it comes back out. You have people who are like, oh, okay, well, the run's over. They start selling off. So what happens? Other people who've missed this trade, they're like, man, I wish I would have got in at like $6. I could have held it to 10. That's a $4 rip. That's $4 per share. You pick up 100 shares of that, you make $400. You pick up 200 shares, you make $800, and so on and so on. So this is what happened. So all this stuff, like, this isn't the run up. This is like still part of the accumulation phase, right? People are starting to see some movement here. Now this is on people's scanners. It's on people's watch list, and they're watching it like a hawk. And what happens? Look at this run up. Boom. Went from right here I would say about $8, and it got all the way up here at the high of 34. See, people thought they ran from $8 up here to like 27. They're like, oh, the run's over. Oh, party. No, it wasn't. So all these people sold off, and it still held. The next thing you know, the next day it gapped up, and then it went all the way to 34. If you could have held from $6, $8 up here to 34, you would have made roughly $26 per share. Now let's go back to when I said, if you had 100 shares, you would have made some money. You would have made what, $400? You had 200, you'd make 800. If you had 100 shares in this thing and you were actually able to hold it from 6 all the way up here to 34, which even I couldn't have done that. Like, there's no way, right? But still, that's $3,400 profit off of 100 shares, right? You had 200 shares, and what would the 100 shares cost you? $600 total, right? $600 total. That's nice, right? So again, when this stock ran, I got in like right around here, right? I actually got it on a day where it was red, and I was like, oh, I missed the move. I was late to the party. Sucks to be me. And then, of course, I held it the next day, and then it gapped up, and look what happened. Boom. And I'm out right up here. Like, when I saw this big giant candle, right? We refer to this as a John Holmes candle. When I saw this, wow, like, I'm out up here, and I'm like, well, you know what? I tried to time the top, didn't happen. Came back down, and then it shot back up. And then, of course, 3-4 days later, I was like, I'm such an idiot. I should have held it, because, man, like, that would have been like an extra $8 on there. So, but that's what happens. So when we talk about the distribution phase, it's a trendless period in which traders and institutions, they're reducing or eliminating their holdings of shares. Usually it occurs after a big run up when a stock is at or near highs. The volume patterns changes, they're the great signals, right? You start seeing more big red candles, right? The bigger the red candles, the more selling off they're doing. Bigger candles and bigger ranges have bigger sell days. So if we go back to this example of iBio, so the big run up, right? Look at this. Like, that candle's huge, right? It went from 22 all the way down here to 12. That's almost like a $10 loss that day. But you can see right down here in the volume candles, look at this. You got the big green days, which is showing you the run-up days. Then you got the big sell-off days right here. Then you got some more big green days. And then guess what? Now here comes the dump, right? This comes the dump. So this run-up phase and the distribution went really, really super quick. Typically distribution, if you're an institution, and like I said, let's go back to the original example that if you wanted to buy 200,000 shares, if you went and bought 200,000 shares at $6, and you got to figure right here, the volume was not 3 point, let's see. I would say the volume right here was probably maybe 300,000. And if you had bought 200,000 shares, like, this would have happened much quicker, and your cost basis would have been much higher. So you wouldn't have got this massive profit, because basically you were pumping the price. So again, once you get this and it comes back down, companies start selling off. They're like, man, the run's over. Like it went too high, too far. And look, and like we got this our 9 EMA right here. Look at the distance, right? I mean, you could probably fit like 3 fists in between that thing right there. That's crazy. So again, it's that far from this 9 EMA. At some point, it's got to crack back. And look what happens. It corrects here, comes back down, and then it busts down through the 9 EMA, busts down to your 20 SMA, and then it kind of finds its footing right here and it kind of holds it. But then guess what? It just trends on back down. So like I said, stocks are either in a period of consolidation, which is over here, right? They're trending either up or they're trending either down, right? So bam, it's up here. We don't want stocks to go sideways, because if you had bought stock here at $4, what did it do for 3 months here? It stayed around $4. Like, I mean, you had a couple days where it was maybe 450 or maybe even 5 if you got lucky. But for the most part, it all stayed just right there. So again, we can take a look at this chart here, or this example. The accumulation comes, the accumulation right here, and then you get the run up. And now this is your distribution. So if you're a company that has 200,000 shares, or maybe even more, maybe you're a hedge fund, maybe you have 1 million shares or something, you can't just sell them all at one time, because first off, not everyone's going to buy them at the price you want to sell them at. So if I want to sell something for $25 a share, but I got people that want to buy my shares, but they don't want to pay $25. Maybe they want to pay 23. I'm either going to have to lower my cost and accept $23 per share, which would be $2 less than what I want. All right. That's what my target was. Or I'm going to have to start selling off some here and there. So that way I'm not dumping it, because the more shares I sell, the faster the stock price is going to drop. So now if the stock price is going to drop, well, then guess what? I'm going to have less profit, because I would like to sell all my shares up here, but I can't, right? Because there's not going to be enough buyers to buy all my shares, most likely. So again, I can't dump it all, because I don't want to dump the price, but I also don't want to dump all my shares. So I'm going to distribute them. I'm going to sell some here, sell some there, right? So maybe I sell some here, takes price down, price comes back up. I sell a little bit more up here, price comes down, goes back up a little bit, comes back down. And then sure enough, we get to the next phase, which would be the rundown phase. The rundown phase is when the supply of stocks has outpaced demand and forced sellers to reduce their asking price, and it drives the stock into a downtrend. The stock makes lower highs and lower lows. So again, real quickly, just to kind of go through this, the stock pushes down, you get stuck in this range, and then here you go, here's your big run up, right? You get the big move. Now you got distribution, right? It's still in the range, right? So this is going sideways. It's not going any higher, but right now people aren't willing to just sell them all. But guess what happens? The rundown phase, which again, liquidation, what happens? Stock just goes shoom. And now you start the whole thing all over again, another accumulation phase. And this is how the stock market works. So let's talk about trend trading. We are trend traders. We want stocks that are trending up to the long side or trending down to the short side. I don't care which way the stock is going, because I can make money to either side. I can make money longing stock. I can make money shorting stock. The one thing you're getting from this course that most trading teachers do not teach is how to play to the long side or the short side. They may show you 1 or 2 patterns, but it's always in one direction. So what happens if I teach you how to be a long side trader, right? So you're always buying things and never shorting them. If I'm teaching you just how to purchase low and sell high, what happens when the market has its crash like it did in 2020 with the COVID-19 pandemic, where every stock was just getting hammered? If you didn't know how to short stocks, you weren't making any money, because there was no opportunity to make money. The stocks were going down and they did not find the bottom for quite a while. But the students I taught, and of course with myself, I knew how to short the market. So I knew what I was looking for. I knew these stocks were going to get hammered. I knew these stocks were going to get crushed. So therefore, because I taught my students how to short sell these trades, they were able to make so much money. They probably made more money to the short side that year than they did to the long side. So I made more money that year than I did the previous 3 years to all my trades to the long side. So we need to remember that stocks get their power from basing. They get their power from consolidation, right? Remember, the consolidation is a sideways. A stock needs the rest after a run. The longer the run, the faster, the more intense the run, the longer the rest you're going to need. The longer a stock rests, the greater the chance that the breakout that comes in the future can be sustained. Trading in the direction of the trend is always the lowest risk, highest reward trade we can take. The trend is our friend. What I'm saying is, if you think about this for a minute, there's many people that have been born and bred. They go to Ivy League schools to learn finance, to learn how to play the stock market, and they typically have connections. They usually have a lot of capital and they can change the way the market moves. So if I want to drive up and pump a stock and I want that price to go up really, really high, and I have a lot of capital, there's nothing any of the retail traders can do to stop me from doing so. Just like if I want to short a stock and I want to drive a company's stock price into the ground, if I have millions and millions and millions of dollars available to me, I could tank a stock in no time. Again, I don't have that power. Would be nice. But that's the thing, is that if you think that you are somehow going to come in one day and be smarter than the market, like, oh, everyone's going to go to the long side, but this is going to be the day it's going to be short. Listen, you might get lucky once, maybe twice, maybe in a few times, but I promise you, more often than not, I promise you it'll be at least an 80% rate that you will come in every day. If you try to counter trend trade against the overall direction of the market or a stock, you're going to get crushed. You're going to lose more often than you win. And sure, it might feel great when you win, but all those losses you're going to accumulate along the way, they're going to suck. So let's talk about defining your trading style. There are two types of short-term trading. There's day trading and there's swing trading. Make sure the style you select suits your personality. So look, day trading is buying or shorting a stock and closing the position within the same trading day. Swing trading is buying or shorting a stock, holding it overnight, and then closing your position within the next day, or within 14 market days afterwards. Anything longer, and you're an investor, right? You need to use fundamental analysis in coordination with your technical analysis. So let's talk about the advantages of day trading, right? So this goes into your personality. So you need to ask yourself some questions before you start picking what kind of style you want to trade. So with day trading, we have the ability to mitigate our risk. So you can get out of a trade if it's not working. So I can get into a trade at 9:30, and if it's not doing anything, I can get out of it. And I can go find me something that maybe gives me a better setup. It gives me a better chance, a higher reward, and a lower risk, right? So that's what we get to do as day traders, is because we are there in front of the computer, we're watching that trade. The second we get into a trade, we're laser focused on that trade and only that trade, right? We're not looking at everything else. We're not surfing the net. We're not watching TV. We're not ordering DoorDash. We are focused on the trade that we're in. If it's not working, we can get out of it quickly. We can also capitalize on short-term movements. There's so many stocks that might get good news in the morning, and the stock will run up from $10 to $15, or from 15 to 30. And then, of course, after all the action in the first hour, which is the hottest part of the market every day, it might retrace. It might people might take their profits and sell it off, and then the stock goes back. There's been many days where I see a stock open up really, really hot. You make a $2, $3, $4 move, and then at the end of the day, it ends up right where it opened at to begin the market day. The other thing that day trading gives us is the efficient use of capital. So again, if I'm a swing trader, right, I'm buying something and I'm holding it overnight, which means any funds I have is tied up in that trade. As a day trader, I can get into a stock, be into a stock trade for maybe 25, 30, maybe 35, 40 minutes at most, maybe even an hour. But the second I hit my target ratio that I'm looking for, right? My reward to risk ratio, which you will learn later on. Once I hit my target, my reward, then I'm out and I'm looking for other opportunities to get into. So I might take anywhere from 5 to 7 trades in a day. There's been days I've taken 14 trades. Some would call it over trading. But again, if there are opportunities and you're winning, yeah, it's worth taking. And also the other thing about day trading is you get profits. If you get good, you can make a lot, even with a really smaller account sizes. Most people think, oh my gosh, I need hundreds of thousands of dollars in order to be a day trader. You don't. I've seen people take swing trading, build their account up, get the minimum $25,000, which allows them to be a day trader, and then turn around and just use 25 grand and their buying power and they're turning around and they're making more money than it took making it much quicker than it took them to make the money from their swing trading. So if you're able to get good at this, you can actually quit your day job and it becomes like your entire source of revenue. So let's talk about the disadvantages of day trading. Listen, it's hard to do with a full-time job. It's damn near impossible unless your boss is willing to let you take an hour or two each day and focus on your trades. I'm pretty sure they're not going to pay you and allow you to continue working there and while you're trading. Also, with day trading, it requires real-time charts and ability to use them, right? Most people, they don't realize that you need to have real-time data. So I can't take a trade on something that's got delayed data from 15 minutes ago, right? If a stock is running, I've done missed the move. So I'm going to be late to the party. Now, the other thing, like I talked about, was you're restricted by PDT, which is the pattern day trade rule. So you have to have $25,000 minimum in your account in order to take more than 3 trades in a 5-day trading day period, right? Also, the other disadvantages is commissions. We need fast access. We need our orders to get filled. And in order to ensure that they're going to get filled quickly and in a timely manner, we're going to need to pay for it, right? We can't count on these free services like Thinkorswim or E-Trade. They're not going to fill our stuff as quick as we need us to. So that's the problem. So we need to figure out how much money we're willing to spend on commissions. The other thing that you need as a day trader is you need skills. You need speed. You need the ability to handle your emotions. If you're an emotional person, like give me an example. If losing $50 on a trade would just ruin your life, it would just ruin your day. You would go home, kick your dog, beat your kids, smack your wife, whatever. If that's what losing $50 in you, day trading is not for you because you're going to lose. It's part of the game. I lose trades all the time, right? Sometimes I guess, hey, this stock's going to run. And guess what? I get stopped out. It happens. You have to be good with managing your emotions. When I trade, many of my students said, it's weird because when you trade without emotion. You trade like you're like a robot. And I said, because you have to control your emotions. What good is it going to do me to get all excited about a trade that's doing well and then maybe reverses back? So maybe I might be up $1,000. I'm going to throw a party, dance around. But what happens when the stock starts trimming back, right? It reverses. And now I'm only making $400, or maybe I'm breaking even, or maybe I'm taking a loss at that point. You celebrate when you win, but you celebrate after the trade is closed. If you lose a trade, you cry after the trade is done, not beforehand. You got to control your emotion. Also, you have to have mental capital, right? We're only good for so many decisions in a given period of a time during the day, right? In the morning, you're the most fresh. Think about when you're working. When you go to work at 9 o'clock in the morning, you're probably your most fresh. And you're in there and you're ready to do some work for your boss. And then what happens? As the day goes on, your decisions aren't as great, right? You're not as motivated. You go to lunch, you come back, you're a little tired. And you're thinking, I want to take a nap. I don't want to do any work. Same thing, mental capital. We're only good for so many decisions in a day. So we can't waste our mental opportunities on things that are irrelevant. Like, what am I going to eat for breakfast today? What am I going to do tonight you need to be laser focused. And that's the last thing is you have to be focused on what you're doing. The advantage of the swing trading, listen, swing trading is nice. It can give you substantial gains over several days, right? You don't have to sit there and micromanage your trades. You don't have to sit there and watch everything like, oh my gosh, the stock ticked down a couple points. Should I sell? No. Like, listen, you don't need to do that because again, you're using patterns that are showing you what you need to do over a period of time. It's not like you get into a trade and then, oh, it's not working. I got to get out right now. And the other cool thing about swing trading is you can do it with a full-time job. Many swing traders, they put their orders in at the end of the day. They want to see how the stock does during the day. And if the pattern still continues to hold, they'll put their order in and then they hold it overnight. And then a couple of days later, if they hit their profit target, they sell out, they take their profits. The disadvantage of the swing trading is, listen, it's harder to make gains in a choppy or a range-bound market. So when the market's all going sideways, right? When the S&P 500, when Apple and Amazon and all the big name corporations, when their stock prices are all kind of going sideways, it's hard because there's no edge. Remember, we're trend traders. We want to be trading on stocks that are trending up or trending down. If it's trending sideways, that's range bound. We can't make no money in that. It's also hard to make consistent daily income swing trading because, again, most of your trades are going to be multiple days. So, unless you have a trade for every day of the week that you can potentially close for a profit, it's going to be harder to make daily income. Didn't say you can't make weekly, monthly income, weekly income, perfect. Daily, it's probably not going to make you enough money to quit your day job. Also, it's a less efficient use of capital. If you take your money and you're in a sizable position for a stock, that money's tied up. You can't use that money for anything else, right? So you're not very liquid at that point. Your money is tied up into a stock, and you can't go stock hopping, which, when I say stock hopping, many people get into a trade and they're like, this is my trade. This is the trade I want to be in. And then they see another trade going, right? Dance with the girl that brought you. If you did your homework, you followed the rules of the pattern, let the stock trade work. You might get stopped out. If so, then you have capital that you can use on another trade. But most people, that's the hard part of it, is that if you only have, say, 20 grand or even 15 grand and it's tied up in a trade, well, you can't take 3 more trades on top of it. And also, with swing trading, it requires a different type of discipline. Swing trading requires a different type of discipline. So with day trading, you got to be laser focused, right? But with swing trading, you still have to be disciplined to the point that you need to be mindful of what the stock is doing. Each day, you need to check and see where the stock price is. Do I need to raise or lower my stop loss, right? So if the stock is moving up, then I need to raise my stop loss in to lock in some profits. Or, I need to be mindful of where my stop loss is. So you don't want to just take a trade and be like, yeah, I'll come back and check in a month. You need to be mindful. So you still have to have discipline, but you still have to take your time each and every day. And you still have to go through your charts and find stock opportunities, either through your scanner or through your watch list of stocks that meet what your criteria, what you're looking to trade.